Adobe operates across 3 clouds. Creative Cloud, 20-plus apps including Photoshop, Illustrator, Premiere Pro, After Effects, and InDesign, is the professional standard for design, video, and publishing. Document Cloud, Acrobat and Sign, dominates PDF creation and e-signatures. Experience Cloud provides enterprise marketing analytics and personalization. Adobe completed its transition from box software to subscription in 2013. Creative Cloud now generates $14 billion in annual recurring revenue from 30 million paid subscribers. CEO Shantanu Narayan has led Adobe since December 2007, overseeing the cloud pivot, building Experience Cloud through acquisitions, and launching Firefly AI across the product line. Valuation. Adobe trades at 9.7 times EV to free cash flow. The historical range was 14 to 43 times. Current multiple, lowest in over a decade. FCF yield 10.3% versus 4.3% Treasury, premium of 6 percentage points. Zero growth perpetuity, if Adobe's free cash flow never grew again. Intrinsic value at 10% discount is $228 per share. Current price $234 is essentially at the zero growth floor. Conservative DCF at 5% growth and 10% discount, $388 per share. All scenarios above current price. 4 numbers define Adobe. Return on invested capital, 36.7%, accelerating from 19% in 2019. Revenue has compounded at 13.4% annually, reaching $24 billion. Free cash flow margin, 41%. Free cash flow, $9.85 billion in fiscal 2025. Trading at 9.7 times free cash flow, the cheapest valuation for Adobe in over a decade. Phase 1 Forensic Screen, 8 signals, 2 yellow flags. Revenue grew 113% over 6 years. Net income grew 142%, faster than revenue. Confirming genuine operating leverage, not accounting manufacturing. Free cash flow exceeds net income every single year. FCF to net income ratio between 1.01 and 1.56 across all 7 years. Days sales outstanding improved from 50 days to 36, customers paying faster. Operating margin expanded 7.3 points, twice the gross margin expansion. The 2 yellow flags. First, fiscal 2024 net margin compressed to 25.9%. This was the $1 billion Figma deal termination fee, paid after EU and UK regulators blocked the $20 billion acquisition in December 2023. Net margin recovered to 30% in fiscal 2025, confirming the charge was singular. Second flag, fiscal 2020's net margin spiked to 40.9%, a large deferred tax benefit. Also singular, also reversed the following year. ROIC is the definitive signal, 19% to 37% accelerating. Forensics passé. Phase 2 Financial Analysis. Revenue grew from $11.2 billion in fiscal 2019 to $23.8 billion in 2025. A compound annual rate of 13.4%. The driver, Creative Cloud subscription growth plus annual price increases. Each subscriber added contributes near 100% gross margin. Because once the software platform exists, distribution is essentially free. Fiscal 2023 and 2024 showed modest deceleration, 10.3% and 10.8% respectively, reflecting post-pandemic normalization of software spending, not structural weakness. Fiscal 2025 recovered to 10.6%, with free cash flow jumping 26%. Margins tell the operating leverage story. Gross margin expanded 3.6 percentage points, from 85 to 88.6%. Operating margin expanded 7.3 points, from 29.3 to 36.6%. Operating margin growing twice as fast as gross margin confirms genuine operating leverage. SG and R&D growing slower than gross profit. Exactly what economies of scale in SaaS look like. The fiscal 2024 dip to 31.3% operating margin traces entirely to the Figma termination fee, a one-time event. DuPont decomposition shows the quality of Adobe's return improvement. Return on equity rose from 28% in 2019 to 61% in 2025. Which levers drove this? All three simultaneously. Net margin, recovering from the Figma fee compressed 25.9 back to 30%. Asset turnover improved from 0.54 to 0.81. Revenue growing faster than the asset base as the SaaS model scales. Financial leverage, rising from 1.97 to 2.54, driven by $11.3 billion in buybacks reducing equity, not reckless borrowing. Diagnosis, all three DuPont levers improving through genuine operational performance and disciplined capital return. ROIC at 36.7% confirms the improvement is real. Phase 3 moat assessment, 8 of 9 filters pass. Adobe has 3 confirmed structural powers. First and most important, switching costs. 25 years of professional file format dominance. .psd, .ai, .ind, .proj. Switching away from Adobe means retraining entire creative teams. 12 to 24 months and $50,000 to $200,000 per team. It means migrating years of accumulated creative cloud libraries. Breaking compatibility with the deliverable formats clients expect. Leaving the professional certification ecosystem built entirely around Adobe tools. Enterprise clients face additional IT procurement complexity and volume licensing inertia. Second, scale economies. $4.3 billion in annual R&D, 18% of revenue. Funds 50-plus products that no standalone tool can match. Third, branding. Photoshop is a verb, Adobe is the professional standard. The tutorial and certification ecosystem is built entirely around Adobe tools. 40 years of professional hysteresis cannot be replicated by capital alone. ROIC at 36.7%, 7 consecutive years above 19%. Moat wide. Phase 4 Capital Allocation. Shantanu Narayan has returned $41.5 billion in buybacks over 7 years. Share count reduced 13.2%. Genuine per-share improvement despite $11 billion in stock-based compensation. The buyback timing story has 2 chapters. Fiscal 2021 and 2022. Buybacks at 40 to 60 times EV to free cash flow, overpriced. Fiscal 2025. $11.3 billion at 9 times EV to free cash flow. That is the best capital allocation decision in Adobe's history. Narayan is buying the most undervalued asset available. Adobe's own stock at below zero growth intrinsic value. One notable failure, the $20 billion Figma acquisition attempt, blocked by regulators in December 2023, with a $1 billion termination fee. Tuck-in acquisitions throughout the 7-year window were mostly disciplined. Capital allocation, pass. Phase 5 Competitive Dynamics. Adobe is in the stability stage, a 40-year-old company with structural powers built during the PC and internet takeoffs. Switching costs were established when Photoshop became the industry standard in the 1990s. Those 25 years of file format lock-in are permanent infrastructure. The AI transition is the key question. Generative AI tools, Midjourney, DALL-E, Stable Diffusion, can bypass the image creation step. Adobe's response. Firefly, their generative AI model trained on 500 billion Behance and stock assets, integrated directly into Photoshop, Illustrator, Premiere and Express. The counter-positioning threat is real, but Adobe's integration strategy converts AI-generated content back into the Photoshop workflow for editing, compositing and export. The most important data point. ROIC accelerated from 25.4 to 36.7% in fiscal 2025. the year generative AI disruption was supposedly at its most severe. Moats under attack do not accelerate their returns. Overall verdict: green buy. Adobe passes all 5 phases with no red signals. Forensics pass, moat wide, financials pass, capital allocation pass, competitive dynamics durable. The moat is confirmed through 3 structural powers: switching costs, scale economies, and professional branding, all established over 25 to 40 years of market leadership. The financial profile: free cash flow compounding at 15.7%, ROIC accelerating to 37%, is among the cleanest in global software. And the valuation case is the strongest element. The stock trades below its zero growth intrinsic value. The AI disruption risk is real but misdiagnosed. Generative AI augments Photoshop workflows. It does not replace them. Adobe Firefly positions the company as the AI delivery layer for creative professionals, not a casualty of the AI transition. Greens buy. The 10-minute test is a quality gate, not a verdict. 8 of 9 filters pass. Nasdaq listed, regular SEC filer, KPMG auditor, check. Profitable all 7 years. Lowest net income $2.95 billion in fiscal 2019. Check. Operating cash flow positive all 7 years, growing from 4.4 to 10 billion. Check. Return on equity above 10% all 7 years, range 28 to 61%. Check. EPS $6, 1083, 1002, 1010, 1183, 1236, 1670. Clear upward trend. One dip in fiscal 2021 from workfront acquisition amortization, not operational deterioration. Yellow. Balance sheet D/E 0.57 times interest earned 33 times. Debt is entirely funded by excess cash generation, not financial stress. Free cash flow to sales 35 to 44%, top decile globally for any industry. 0 restructuring charges in 7 years. No recurring non-recurring items. Share count reduced 13.2% through consistent buybacks. Check. Result 8 of 9, exceptional quality gate pass. Share count 492 million in fiscal 2019. 427 million in fiscal 2025. A reduction of 13.2% over 7 years. Net reduction is meaningful. 41.5 billion in buybacks exceeded 11 billion in SBC issuance. The largest single-year buyback was fiscal 2025. $11.3 billion at 9 times EV to free cash flow, when the stock was at its cheapest valuation in over a decade. This is the correct outsider allocator pattern. Largest buyback at the lowest relative price. Adobe pays no dividend, all capital return is through buybacks. Cash deployment audit over 7 years. Total free cash flow, 47.3 billion. Total buybacks, 41.5 billion, 88% of free cash flow. Adobe pays no dividends, all shareholder return is through repurchases. The pattern is clear: buyback acceleration when the stock is cheapest. 2.75 billion in 2019, at 51 times P/E. 11.3 billion in 2025, at 13.6 times P/E. The fiscal 2025 buyback at 9 times EV to free cash flow is likely to prove the most value-accretive capital allocation decision in Adobe's history. Total free cash flow generated significantly exceeds total buybacks. The balance funded acquisitions, R&D investment, and the Figma termination fee. Financial health. Long-term debt, 0.99 billion in fiscal 2019, rising to 6.57 billion in 2025. The increase reflects debt issuance to fund 11.3 billion in buybacks, a rational use of low-cost debt when equity is trading below intrinsic value. Times interest earned, 21 times in 2019, rising to 59 times in fiscal 2023, then declining to 33 times in 2025 as debt increased. At 33 times, Adobe could service its debt, even if EBIT fell 70%. The entire limited balance of $6.6 billion could be retired from less than 1 year of free cash flow. 3 independent valuation methods. First, cash return. Free cash flow of $9.85 billion against enterprise value of $95.6 billion. Cash return 10.3%. The 10-year Treasury yields 4.3%. Adobe pays a 6 percentage point premium over the risk-free rate. For a quality wide moat compounder, 2 to 3 points is sufficient. Adobe doubles that. Second, P/E versus history. Current 13.6 times. Historical range 2019 to 2024, 34 to 61 times. The stock has not been this cheap on earnings in over a decade. Third, DCF base case. At 5% free cash flow growth and a 10% discount rate. Equity value, approximately $166 billion. Per share, $388. Current price, $234. All 3 methods agree, significantly undervalued.